Moving on to the final trade of the day. Speaking of the Fed, Jim's trading the 10-year ahead of the jobs report for us and next week's big Fed meeting. What are the levels, Jim?
It's still a little below the stop-in level. 126.17, I think, is a spot to stop yourself in for a long. Looking for 127.13 on the upside. A stop placed below 126.04. One of the things I'm keying on here, and I know when stock markets rally, it's a little more difficult for the long end to rally, but I did see that prices paid component of the number today and thought, wow, the Fed, unless we're getting some great numbers, may start walking back their tough talk, in which case I think stocks and bonds could potentially rally together.
Short term, I'm not going to push back too hard on this trade just due to the fact where I see the S&P 500. But longer term, I'm not going to agree. Why? The Fed at 260, they raised rates a month and a half ago, 2 months ago, right? Now it's at 222. Right. This is the low end of the 10-year yield. So the Fed, they have to continue to chirp and talk to try and get that long end of the curve up higher. And I think that's really problematic. And they're gonna falter, they're gonna stumble, but they are gonna be very forceful in their message on the long end of the curve.
By the way, just to be clear though, for the last couple of months, yields have been trending lower at the same time the stocks have been making new highs, week to week. And that's something that's interesting to me. The one thing that I like about this trade, and I was curious if you like this too, it seems to me that the stocks and bonds could rally together. If stocks all of a sudden start to head south, then all of a sudden bonds flip from being just a haven to a safe haven, and all of a sudden they could get their normal inverse relation.
And if we really see the market pull back here, when you look at the 10-year here in the United States versus the 10-year anywhere else in the world, yes, it is juicy. There's some meat on the bone, and that could obviously be a little win in your sales. But right now, I think the Fed is going to grab that microphone until that June meeting, where they are. The CME tool here, the Fed Watch tool, it's like a 92% chance of moving.
June is a done deal. And let's say tomorrow is a disappointment. I mean, they're going to go in June. I believe that. There's no question.
You think if we have a 50,000 job number, they're on pause?
No, I don't think that. I think if they have a 50,000 jobs number, we take it from 90% to 60%, and then I still think they hike in June, but I think their rhetoric switches.
Jim, given that we have a new president that is tweeting up a storm.
Oh, we do? Yeah, you're right about that.
Heard about him.
Just, a few headlines coming out each day about what's going on in Washington. Do you think this is a more volatile summer than we've seen in the years past, and should investors brace for that?
I think that I hope so, because I like volatility as a trader. From a citizen standpoint, though, yes, I worry about it. And that's one of the reasons that I have been talking about gold for the last few months, because the one thing we have to agree on is that the situation in Washington is clearly less predictable than at any time I've seen in my lifetime. So things like owning gold, probably owning U.S. bonds, too, despite the fact that the problematic headlines could be coming out of the U.S., people still tend to buy bonds. So underline that fact, once we got downgraded once, and the reaction in the bond market was to buy, not sell the very thing that was downgraded.
I think it's also important to remember that we were bracing for volatility with a new President Trump. The market has never been less volatile from a realized perspective. Amen. The VIX is at 10.
Well,
we have seen zero volatility since he's taken over. So I think you have to be conditioned to understand, yes, it can revert.
But there's a reason for that, because nothing really has happened yet, despite all the headlines that we've seen. If some of these stories, these side narratives, and some of these themes pan out, i.e. Russia, could we have a bigger problem on our hands?
Are you asking this question because that's what you believe too? And remember, we're talking about this partly as traders, but partly as just citizens.
Right.
You're plugged into the news every bit as much as we are. You're saying it because you believe that he's a wild card and there could be something crazy that comes out of it. Yeah, sure, I agree with you.
I'm just, look, I saw the tweet the other night.
We have seen a lot of crazy.
In the middle of the night, Kolfefe or whatever it was. Remember, did you see
yes.
that? I mean,
you don't know what Kolfefe means?
You don't know what's going to come out.
On that day?
Pull the political views aside here. All I'm just saying is that we have seen some sensational news cycle. We have seen some craziness stem out of the new administration. It hasn't translated into any type of volatility. It's actually suppressed volatility.
You're right about that.
So that's my only point. We continue to brace, and we're hitting all-time highs, and the VIX is dipping under 10 here as we speak.
Okay, let's get the risk reward on this trade and put this show to bed here. Jim's buying the 10-year note, 126.17, targeting a move to 127.13. Each tick in this trade is worth 31 1/4, so he's risking just over 405 to make 875. All right, that's going to do it for today's show. Thanks so much for tuning in. My thanks to Jim and Jeff coming to us from Chicago. Meantime, if you missed anything, head back to the website, futuresnow.cnbc.com. Everything is there for you. And for the latest headlines and a sneak peek of what's coming up on the next show, be sure to sign up for our brand new newsletter at cnbc.com/futuresnow email. You can find that link and real-time trade updates on our Twitter account. Handle there is @CNBC Futures Now. Otherwise, we'll see you for our next live broadcast next week, Tuesday, 1 p.m. Eastern. See you then.